Welcome back to the Deep Dive. Today, we are putting the textbooks away and getting right into the practical side of things.
We are. You've brought us this amazing set of resources, basically strategic blueprints for 10 different ways to build an ETF portfolio.
Yeah, and we're going to move past just the theory of ETFs and look at, actual concrete examples from super simple, like a 100% stock approach.
All the way to these famously complex, crisis-proof designs. It's the perfect deep dive.
And our mission today is really important. It's not to tell you which of these 10 is the one you have to pick.
No, not at all.
The goal is to use these as, I guess, inspiration. A set of frameworks to help you build a portfolio that really feels right for you, for your own risk tolerance and your goals.
That alignment is everything. I mean, the sources really lean into this. Channeling the investor Howard Marks, he basically said, there is no ideal portfolio, only the one that suits you.
Right. If it's keeping you up at night, it doesn't matter what the potential return is.
Exactly. It's the wrong portfolio for you.
Absolutely. Okay, so before we unpack these 10, maybe we should just quickly lock in the language we're going to be using, a quick glossary.
Good call. Yeah, there are 3 terms we're going to be saying over and over. First is the portfolio.
And that's just everything, right? The whole collection of what you own, stocks, ETFs, real estate.
The whole shebang. Second is allocation.
Or distribution. Basically how you slice up your money, which we'll always talk about in percentages.
Yep. 60% stocks, 40% bonds, that kind of thing. And third, net worth.
Assets minus liabilities. We focus on this because, really, it's the only way to see if you're making real progress, no matter what the market's doing day to day.
And one last thing, a key piece of advice from the sources right up front. Avoid fragmentation.
Oh yeah, this is a big one. It's so easy to get carried away and own dozens of things.
Right, but the recommendation is to aim for, say, 5 ETFs plus or minus 2. Simplicity just makes it so much easier to manage.
If you're trying to track 30 different things, you're not investing. You're just bookkeeping.
Exactly.
Yeah.
Keep it focused.
Okay, and just a quick essential reminder. This is all educational. It is not personalized investment advice.
Please do your own research.
And always remember, markets are uncertain. Past performance guarantees nothing. And any investment carries a risk of loss. Okay. With that said, let's get into the foundational structures.
Let's do it. We're starting with the 2 extremes. Maximum simplicity versus maximum caution.
First up, the big one. The minimalist approach. 100% global stocks.
This is the purest expression of long-term optimism you can get. The allocation is just 100% in a single ETF, like one that tracks the MSCI World or the ACWI index.
The idea is just to capture global economic growth over, say, decades without any fuss.
Exactly. The sources call it the simplest, but far from the dumbest.
I like that.
Oh.
The pro is obviously the simplicity and the high potential for performance over 15 or 20 years. But the con?
The con is huge. You are 100% exposed. If the market tanks, you're riding it all the way down. That takes some serious psychological strength.
Yeah, it really does. And that massive volatility, I guess, leads us right to the total opposite approach.
It does. It takes us to the conservative portfolio, or what you could call the safe harbor. It's for the investor who wants to, quote, sleep soundly, but still invest.
That's a goal I think a lot of people can get behind. So how does it achieve that peace of mind?
Well, it spreads the risk out way more. It's 30% in global stocks.
Only 30%.
Only 30. Then another 30% in investment-grade bonds, 20% in cash or money market funds, 10% in gold, and 10% in real estate funds, like REITs.
Wow, what a difference. From 100% risk to just 30% in stocks. The upside is clear. Low volatility, stability. It's probably a great way for a new investor to get started.
It is. It builds confidence. But the flip side is that performance ceiling. I mean, if we get a huge bull market or high inflation, that return might start to feel...
A little frustrating.
Yeah, frustratingly limited. You're trading that high growth potential for total peace of mind.
Okay, so that sets up the next section perfectly, where we start to look for the middle ground, blending some of that stability with more growth.
Exactly. And the first one is the balanced portfolio. The goal here is, a good compromise. You want long-term returns, and you're willing to accept maybe a few negative years here and there.
So the allocation shifts a bit more toward risk.
A little bit. It's 40% in global stocks, 30% in bonds, 10% in emerging market stocks, 10% gold, and 10% in real estate.
So that extra 10% in stocks is split between global and emerging markets.
Right. And this is often the portfolio for people who start with the conservative one and then realize, hey, I think I can handle a little more risk. The sources actually mention a case study, an investor named Sandra,
Oh, right.
and she said, that suits me, I want to move forward. It really clicked for her.
And the main drawback to something like this.
It's just that it needs a bit more attention. You have to rebalance it periodically to keep those percentages in line. It's not a set it and forget it like the 100% stock model.
Okay, so now let's push the throttle forward. For someone with a really long time horizon, say 15, 20 years, who is aiming for maximum velocity.
Now you're talking about the high-octane strategy or the growth portfolio.
And this one is pretty aggressive.
Very aggressive. It's heavily weighted to dynamic assets. You're looking at 70% global stocks, 10% emerging markets, 10% small cap stocks.
So 90% in stocks.
90%. Then 5% in gold. And, this is the interesting part, 5% in cryptocurrencies, specifically Bitcoin and Ethereum.
Okay, that 5% crypto is a huge departure from the other models. What's the thinking there? Why add something so volatile?
So the sources frame it less as chasing volatility and more as a bet on an asset class that's still maturing. The argument is that crypto often moves independently of stocks and bonds.
So it's a diversification play through something uncorrelated.
Exactly. It's an anti-correlation argument. But you're right. The limitation is that extreme volatility. You absolutely need a big cash reserve outside this portfolio to handle the swings.
And to maybe buy the dips when they happen.
Precisely. This is not for the faint of heart.
That discussion about risk and being able to stomach the swings, it brings us perfectly to the next section. A personal example designed for what they call anti-fragility.
Right. This is the robust design, an expert's personal portfolio. The whole idea here is building a global strategy that balances growth with real assets with a huge focus on resilience.
Let's break down the numbers. It's 50% in stocks, but it's really diversified within that 50%.
Yeah, it's not just one ETF. It's mostly a global one, but with smaller tactical allocations to emerging markets, Europe, and U.S. small caps. Then you have 10.5% in commodities.
Split between gold and a diversified commodities fund.
Right. And another 10.5% in real estate.
Okay, so if I'm doing the math, that only adds up to 71% with the other 30%.
And that's the key. The remaining 30% is the strategic reserve. The source makes a huge point that this is not just idle cash sitting in a bank account. It's an actively managed allocation.
Actively managed. How do you actively manage a reserve?
It's structured in layers. So about 10% is in an account you can access instantly for emergencies.
Okay, total liquidity.
Right. Then another 10% is in something like a high-yield savings or an insurance-backed fund that offers a better yield but can still be accessed pretty quickly.
And that last 10%.
That goes into a tax-advantaged long-term savings plan. The funds are locked up for a bit, usually 5 years, but you get big tax benefits. It also creates a psychological barrier so you don't dip into it for no reason.
That layered approach is brilliant. It means you have different tools for different situations. A market crash is different from a personal emergency.
That's the whole point. The analysis says this reserve is what allows you to, lean in and buy more when everyone else is panicking.
But the downside is pretty obvious.
It is. This is highly fragmented. It requires a lot more active management and rebalancing than just buying one or two ETFs. It's a lot of work.
Okay, let's pivot now. We've seen personal and theoretical models. Now for the heavy hitters, the most famous time-tested portfolios out there.
We're starting with the grandfather of passive investing, the Bogleheads 3-fund portfolio from Vanguard's founder, John Bogle.
The philosophy here is just ultimate simplicity. Maximum efficiency with the fewest possible ETFs.
That's it. The allocation is 60% U.S. stocks, 20% international stocks, and 20% U.S. bonds. It's simple, it's effective, and it has a strong U.S. bias, which you just have to accept.
And the main constraint for a non-U.S. investor would be currency risk.
Yep, you have to manage that. But the efficiency is undeniable.
Next up, the Permanent Portfolio by Harry Brown. This one's famously called the lazy investment that sleeps easy.
And it really is. The goal is ultimate stability by making sure something in your portfolio is working no matter the economic weather.
The allocation is so elegant, it's a perfect split.
It is. 25% stocks, 25% gold, 25% long-term bonds, and 25% cash.
And we should probably slow down here and explain why that specific split is so clever.
We should, because each of those 4 assets is designed to thrive in one of the 4 main economic environments. Stocks do well in times of prosperity.
Cash is king in a recession.
Gold protects you during inflation, and long-term bonds do well in deflation. By holding all 4, you're always covered.
That's incredible. It's a beautiful design. But Looking at that 25% in long-term bonds, I have to ask,
Yeah.
what about rising interest rates? We saw how much that can hurt.
And the sources absolutely call that out. That is the critical weakness. When central banks hike rates, those older bonds lose value, and it can really drag down performance. It's super robust, but the returns can be pretty medium.
And that weakness is exactly what Ray Dalio was trying to solve with his all-weather portfolio.
Yes. The key idea here is engineering a portfolio that's resilient through all economic seasons, but with a more sophisticated weighting.
The goal's the same, but the execution is more complex. It's built to handle growth, recession, inflation, and deflation.
And allocation reflects that. It's heavily weighted toward assets that do well when things are bad. It's only 30% stocks. Then you have 40% in long-term bonds, 15% in medium-term bonds.
Wait, so that's 55% in bonds? That's massive.
It's huge. And then 7.5% in gold and 7.5% in other commodities. The balance is extreme. The volatility is very low.
But the trade-off is pretty clear. When the stock market is just on a tear,
This portfolio gets left behind. The diversification becomes its own disadvantage. The sources say it can underperform by 3 to 5% a year during those big bull runs. You're sacrificing the peaks for maximum defense.
okay, fourth on our list of famous strategies is the coffeehouse portfolio. This one focuses on advanced diversification with a tilt towards small and value stocks.
Right. So the overall split is 60% stocks and 40% bonds. But that 60% in stocks is broken down into 6 different categories.
The six.
6. Large cap, small cap value, international, real estate, and emerging markets. The idea is to have a piece of every part of the market.
That sounds complicated to manage. It feels like you'd need a huge spreadsheet just to rebalance it.
It does take discipline, that's its main limit. But it offers a fantastic risk-return profile by touching all those different factors.
All right, and the final one we're looking at is the golden butterfly portfolio, which is sort of a twist on the 12-minute portfolio.
It is. It's designed to keep that resilience, but add a little extra kick of growth.
How does it do that?
It maintains a 5-way split for balance. 20% stocks, 20% gold, 20% long-term bonds, 20% short-term bonds, and here's the kicker. 20% in small cap value stocks.
Ah, so that's the growth engine. You get the stability of the permanent portfolio structure, but with a factor known for higher long-term returns.
That's the idea. The main constraint, again, is often a heavy U.S. bias, so a global investor needs to be careful in how they build it.
Okay, that was
Yeah.
a lot. 10 distinct blueprints for building a portfolio.
Yeah.
So what's the final takeaway for you, the listener, now that you've seen all these different frameworks?
The synthesis from all the sources is really clear. These are not prescriptions to be followed blindly. They're starting points.
Bases to build from.
Exactly. The real value isn't in copying the percentages perfectly. It's in understanding what you own and why you own it so you can build something that lets you sleep at night and stick with the plan.
It really all comes back to that Charlie Munger quote, which the source material uses perfectly. He said, "Take ideas where they are, but use your own brain to assemble them."
It's the perfect way to think about it. This whole journey is about your own education and using these proven models as your guide.
And for anyone who wants to go even deeper, the sources we used also had some great tools, like spreadsheets for tracking your net worth, and even lists of thematic ETFs if you want to explore beyond these broad models.
Yeah, things like AI, luxury goods, all sorts of niche areas for those who are curious.
Fantastic. Well, if you found this deep dive valuable, if it helped you make sense of all this, please go ahead and like the video and subscribe to the channel.
And if this content has inspired you, if it's got you thinking about buying back your own freedom through smart, informed investing, please comment below with the single word, freedom.
Until next time, keep diving deep.